Hi, I'm Seth Freudberg. I'm the Director of Options Training here at SMB in Manhattan, and welcome to our weekly options lesson. Today we're going to be talking about buying a call around earnings on a stock that you think is going to go up as a result of the earnings announcement. You have a feeling that the market is going to like the earnings announcement for whatever reason you formed that opinion. So you would think, hey, buying a call on a stock that's going to go up, you're going to make money. So today's presentation is entitled, Why It Can Be a Very Bad Idea to Buy a Call on a Stock That You Think is Going to Go Up. Now, we're going to bring back the late Steve Jobs to ask, are you nuts? And he's asking me that, and I think the answer to the question is maybe. And it really depends. Don't you want to buy a call on a stock if you think the stock is going to go up? And the answer is very much dependent on the situation. Now, all other things being equal, you do want to buy a call on a stock that's going up unless the implied volatility of the options chain related to that stock will go down so substantially that it will offset the gain from the stock going up. And that happens under certain circumstances. The other reason that you might not want to buy a call if a stock is going up is if you're buying it so far in advance of the expiration of that option that a long period of time decay could occur such that even if the stock does go up, it doesn't go up enough to offset the drop in time decay that occurs with every option, as every option is a wasting asset. So let's give you a modest example of where buying a call on a stock that you think is going to go up might not be such a successful idea. So let's take a look at Netflix. Last week, Netflix was set to announce its earnings after the market closed on April 19th. At that time, Netflix was trading at $3.48. And let's just suppose you felt that Netflix was going to have a very wonderful earnings announcement and the market was going to love it. Let's say, for example, you decided to buy the 1170 option, the 1170 call option in the May 3rd weekly option. And let's just suppose that you thought that that was a good idea, that you felt strongly about the earnings announcements. Now, the earnings came out April 19th, and guess what? The market fell in love with the earnings announcement. So much so that by the end of the next day, the stock had gone up more than 24 points, and the stock trading at 348, if it goes up to 372, say 373 area, that means your 370 call that you bought for $11.60 the day before actually is in the money now. So you'd think, hey, if 22 points below or above the money, that option is worth $11.60. If it's $3 in the money right after the earnings announcement, that thing should be worth a heck of a lot more, shouldn't it? Well, guess what? It was not. In fact, it was worth 25 cents less. Now, why? How could that be that a stock went up 22 points, you bought an option that was out of the money by 22 points, and it went into the money, and the call option that you bought went down? You'd be pulling your hair out, right? You made exactly the right call, and you lose money. Now, how could that happen? And it's very simple to explain. Every option has an element of its value called the implied volatility. And the implied volatility is a portion of the time value of the option that relates to basically fear in the marketplace about movement of the stock. Right before earnings, the options volatility of all stocks blows up. It skyrockets. Because, why? Because it's obvious that there's uncertainty and the stock could respond very poorly to the earnings announcement or very strongly to the earnings announcement. Since you don't know, the options market makers don't want to take a chance of getting killed, so they pump up the value of the options. And what happens right after the earnings announcement come out is there's no longer uncertainty, and therefore that volatility, which is really in a sense a measure of uncertainty, comes out of the options. Therefore, an option which is blown up in value will have, like, think of it like a balloon. Air, just lots and lots of air comes out of that balloon right after earnings, because now there's certainty, which replaces the uncertainty. So what happened in this case was there was so much uncertainty around the Netflix earnings that even a 22-point out of the money call had a very, very inflated volatility embedded in its options price. But after that was over, all the air came out of that balloon, and so much value was lost because of the uncertainty being replaced by certainty that even though the stock went up, your 1160 investment actually dropped in value. So what's the moral of the story? The moral of the story is that buying calls or puts around earnings is very, very risky business, because you are buying something that is temporarily inflated. Now, if Netflix had gone up 100 points or 50, 60 points, that call would have been a great buy. But at 22 points, it just turns out, just so happens, that actually it was a loser, even though you would have expected it to be a winner. So buying options around earnings is very risky. It is a professional's game. There are tools that you need to use to sort of measure where volatility will go before and after options earnings are announced relative to the options, and it is something a skill you could certainly learn, but it is not something that happens overnight, and it's not something that a new trader to the options world should just jump into. There's a good likelihood you're going to lose money doing that because of this issue of options volatility. So don't trade options around earnings unless you have proper tools and you have some experience and you have a sense of what volatility is going to do to the options in that options chain once the earnings announcement has been completed. So with that, I'd like to say thank you for attending our weekly options lesson. If you have any questions, please reach out to me, sfreudberg@smbcap.com, and I'll be happy to answer your questions. Take care, and we'll see you next week. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.